How are distressed assets valued in debt restructuring? Imagine trying to figure out what a broken-down car is worth. That's similar to how experts value distressed assets during debt restructuring. When a company faces financial trouble, its assets are often worth less than in good times. To get an accurate picture, valuators use different methods that consider the company's current struggles and future possibilities. First, they look at asset-based valuation. This means adding up the value of each asset like buildings, equipment, and inventory, then subtracting what the company owes. If liquidation is likely, this gives a minimum value since assets would be sold quickly to pay creditors. Next, market-based valuation looks at what similar distressed companies or assets are trading for in the market. If a company's debt is traded publicly, current market prices can give a real-time snapshot, but these prices can be very volatile. Analysts also use trading multiples from comparable companies to estimate value relative to earnings or sales. The discounted cash flow method estimates the present value of future cash flows the company might generate. Since distressed companies are risky, analysts adjust these cash flows downward to reflect higher chances of default or restructuring. Recovery rate analysis is another key approach. It estimates what percentage of the debt's face value investors might recover if the company defaults or goes bankrupt. This depends on how senior the debt is, the quality of collateral, and the value of assets. Option pricing models are also used, especially for complex situations. These models treat the distressed company like a call option, where the upside is the potential recovery after restructuring or liquidation, and the downside is the loss of the investment. When valuators start, they usually pick a base value using one or more of these methods, often market prices or discounted cash flows. Then, they adjust this value to account for risks like the chance of bankruptcy, lower growth prospects, or costs involved in restructuring. Strategies like reducing interest rates, extending debt maturities, or converting debt into equity can improve a company's future cash flows and lower default risks. Analysts also evaluate whether operational improvements or cost cuts are possible, as these can raise the value of distressed debt. Over time, as markets have faced sovereign and corporate debt crises, valuation methods have become more sophisticated. They now consider legal issues, operational challenges, and market conditions that influence recovery prospects. Knowing how distressed assets are valued helps investors and creditors decide whether to hold, sell, or restructure debt, especially in tough economic times.